Suppose an LBO transaction is valued at $2 billion and has the following characteristics. Exit occurs in 5 years at a projected multiple of 2 times of the firm's initial cost. It is financed with 60% debt and 40% equity. The $800 equity investment is composed of $600 in preference shares held by the private equity firm, $100 in equity held by the private equity firm, and $100 in equity held by the management equity participation or MEP. Characteristics of each of these are also mentioned. So preference shares are guaranteed a 10% compound annual return payable at exit. The equity of the private equity firm is promised 80% of the firm's residual value at exit after creditors and preference shares are paid. Management equity receives the other 20% residual. By exit, the firm would have paid off $700 of the initial $1,200 in debt using operating cash flows. Calculate the payoff of the firm's claimants and the payoff multiple for the equity claimants. Now, to begin with, the value of the investment, the total value, debt plus equity, is given to be $2 billion or $2,000 million, of which 40% was equity, that is $800 million was equity as described, and 60% was debt of $1,200. Now, exit happens 5 years at a projected multiple of 2 times of the firm's initial cost. So exit value will be equal to 2 billion, that is 2000 million into 2, that is $4,000 million. Now, of this $4,000 million, the return of 2000, that is, will be shared between the different claimants who have invested in different amounts with different structures. So the question asks, compute the payoff for the firm's claimants, each of them, and the payoff multiple for the equity claimants. Now, of this exit value, we don't have to pay anything to the debt holders. The debt holders must already be getting their interest every year. Whatever is the final value of the debt, however, we will need to retire. So the firm has paid off 700 of the initial 1.2 billion of the debt, so that remaining debt is only 500 million. The first thing that we will do is we will pay off the debt, and the remaining 3500 will remain to be distributed to the various shareholders. Now, preference shares are guaranteed a 10% CAGR payable at exit. So the preference shareholder had an agreement that I'm going to get 10%, but you don't have to pay me every year like debt. So I'm not going to be a strain on your cash flows. Whenever you exit, whatever amount I have invested, we'll compute a 10% CAGR on it, and that is the value that I will receive. So the preferred equity invested $600 million. Exit has happened after 5 years. So the private equity, or rather the preferred shareholder, would have to be given back a value of 600 into 1.1 to the power 5. That will be equal to 1.1 to the power 5 into 600. That is 966.3. So this is the amount that has to be given to the preference shareholders. The equity of the private equity firm is promised 80% of the firm's residual value at exit after creditors and preference shares are paid. So after creditors are paid, we are left with 3500, and once we've paid the preference shareholders, we'll be left with 3500 minus 966.3, that is 2533.7 million dollars. 80% of this will go to the equity providers, that is $2026.9 million. The remaining 20% will go to the management equity, that is the value of $100 million. So 20% of this amount, that is $506.7 million, would be given to the management equity participants of the structure. So that is how the total value of $4,000 million will get distributed to the various claimants. The question asked is, calculate the payoff multiple for the equity claimants. Now, for the private equity firm, it invested a total value of 600 in the form of preference shares and 100 in the form of direct equity. So on a total investment of $700 million, the private equity firm got 966.3 plus 2026.9. If you divide this by 700, we will get the payoff multiple for equity, which comes out to be approximately 3.6 times. This comes out to be 4.2 times. Similarly, we can calculate the return for the management equity. They invested $100 million and they received a value of 506.7 million, implying a multiple of approximately 5 times on their investment. We can similarly calculate the IRR of the investment for the various participants. They've all invested their money for 5 years. We can similarly compute the IRR for the various participants. They have all invested for 5 years. They all had different present values. Some invested for $700 million to begin with. The management invested $100 million. We know the future value of their investment. We know that the payment in the middle was 0 because we didn't receive except for the preferred equity. Even the preferred equity received the payoff right at the end. So PMT was 0 in all cases, and we can compute I by Y. This I by Y would be the IRR of the investment or the internal rate of return that the investment has given back. If the cash flows were more complicated, we could have used the cash flow sheet as well. In this case, there's only a PV and an FV. Hence, even with the TVM sheet, the question can be solved. A firm is valued at $10 million prior to capital infusion of $5 million. Calculate the post-money valuation and the VC investors' proportional ownership. So from the same formula, post-money valuation will simply be the pre-money valuation, that is 10 million, plus an infusion of 5 million. So post-money would be 15 million, that is the pre-money plus the investment is equal to the post-money valuation. The VC investors' proportional stake is 5 million on an investment of 15 million. Of a total value of 15, he has 5, so his stake is 1/3. Suppose a fund has committed capital of $200 million. That is the amount of commitments that people have given that they will release if you find an investment. Carried interest of 30%, that is 30% of the profits, and a hurdle rate of 10%. The firm called 50% of its commitments in the beginning of year 1. Of this, $60 million was invested in firm A and $40 million was invested in firm B. At the end of year 2, $10 million profit is realized on exit from firm A. The investment in firm B is unchanged. The carried interest is calculated on a deal by deal basis. The IRR for determining carried interest is also calculated for each deal upon exit. Determine the theoretical carried interest and the actual carried interest. If carried interest is calculated on a deal by deal basis, then we'll first analyze deal A. In deal A, the investment has been for 2 years because the commitments were called down at the beginning of year 1. So at t equal to 0, the fund called the commitments 50%, $100 million, and they were exited at the end of t equal to 2, at the end of year 2. So we invested for 2 years. The present value in the case of investment A was $60 million. We'll enter minus 60. The future value was a profit of 10 million, or a total value of 70 million, and we can compute the I by Y, or the interest rate. I by Y comes out to be 8% or 8.08%. Now theoretically he should have been given 30% of the profit as carry, that is $3 million. However, will he be paid anything? Even on the investment in firm A, even though we are paying it deal by deal, he has not met the hurdle rate of 10%, hence no carry will be, or no carried interest will be given. On investment B, he has anyways not made any profit, so there is no question of a carried interest. If this I by Y was greater than 10%, then this entire 3 million would have been paid. Suppose a fund has committed capital of $200 million and earned carried interest of 20%. An investment of $50 million is made. Later in the year, the fund exits the investment and earns a profit of $20 million. Determine whether the GP receives any carried interest under the 3 waterfall distribution methods. So there are 3 distribution waterfall structures that we studied. First is the deal by deal. In the deal by deal, if he's earned a profit of $20 million, which we are assuming is greater than the hurdle rate, then he will get 20% of the profit, that is $4 million as carry. In the second method, where the carry is only paid if the investment exceeds committed capital. The committed capital is $200 million. Hence, no carry, that because 50 plus 20 will still be 70, that will be less than 200 million. In the third structure, wherein the total value exceeds the invested value by a minimum amount. Let's say that minimum amount is 10% of the invested capital. So invested capital in this case is $50 million, which is higher, and current value is $70 million, which is higher than $55 million or 10%. Then again 20% of 20, that is $4 million, will be paid in carry. This is the third method, wherein the value must exceed the invested capital by some amount. Those minimum amounts haven't been mentioned in this question. This should have been, but we'll just assume that the current return exceeds those minimum requirements. Continuing with the previous example, assume in the second year another investment of $50 million is exited and results in a loss of $10 million. Assume the deal by deal method and a clawback with annual true-up apply. Determine whether the general partner must return any former profits to the limited partners. Yes, he was given a carried interest based on a $20 million profit. With a $10 million profit, his net total profit is only $10 million, 20% of which would be $2 million. So 2 million is the carry that he should have. We have already given him $4 million. So we will claw back or take back $2 million from the general partner. If we have fund A and fund B, where fund A has a gross IRR of 20% and fund B has a gross IRR of 5%. Similarly, the net IRRs are given. Fund A is in the first quartile of all funds or all private equity funds. So he is amongst the top 25% of all private equity funds in the country. Fund B is in the third quartile, or he is in the 50 to 75% number as far as performance is concerned with respect to the equity funds in the country. Similarly, the DPI, RVPI, TPI, all ratios are better for fund A but not so good for fund B. However, one thing that we should notice and we should be careful before drawing any conclusion is that the vintage of fund B has only been 3 years, whereas vintage of fund A has been 5 years. So right now fund B's investments may not have done well, or that success story may not have happened, but it very well can happen in the next 2 years, wherein they both probably can look alike. So fund A and fund B are strictly not very comparable, and you should take care of the vintage before you are comparing the funds. If they were of the same vintage, then we can definitely say that fund A has done much better than fund B. The general partner for a private equity fund charges a management fees of 2% and carried interest of 20%. The total committed capital of the fund was $300 million. The question should have also mentioned that carry is placed or carry is paid only after or only when the value exceeds $300 million or when the value exceeds the committed capital. To whatever extent is the value higher than the committed capital. So that is the extent to which the fund manager gets carry in this question. So data is shown in the table below. To begin with, the fund called down only $50 million, wherein the paid in capital was $50 million and the management fees was 2% of the paid in capital, that is $1 million. Please note that operating results don't mean NAV or don't mean any realized return per se. Realized return would be higher than the operating results. Operating results is the dividends, so to say, that you can think, or the earnings of the companies in the portfolio. So 10 million was the additional dividends that the fund got, making the total value of the assets of the fund as 50 plus 10 minus 1, that is $59 million. The carried interest is 0 since the value doesn't exceed $300 million, and the distribution is discretionary. This is at the hands of the fund manager or the general partner, and he has chosen to make it 0. Of course, the life of the fund will be some 10 or 12 years, after which he will anyways have to distribute all the value of the fund to the limited partners. So NAV after distributions comes out to be $59 million, 50 called down, 10 operating, 1 paid in management fees. Next year, he calls another $20 million down. The management fees is calculated as 2% of the paid in capital. That should also have been mentioned generally, because sometimes it can be on committed capital also. So this is 2% of paid in capital, which will be $1.4 million. Operating results are another $20 million, such that the NAV before distribution comes out to be $97.6 million. That is NAV before, that is $59 million earlier, plus $20 million that were called down, plus $20 million that was the operating result that was added, minus the management fees of 1.4, which will give us 97.6. Similarly, we can verify the calculations for 2006, 2007, 2008 and 2009, wherein the paid in capital is now $150 million after the various capital calls. 2% of this would be $3 million, $60 million were the operating results in this year. So the NAV before distribution comes out to be 350.2. The carried interest is calculated as to whatever extent the value exceeds the committed capital once it has exceeded the committed capital. So an increase of 50 million from the committed capital will make the value or will give the carry as 20% of 50.2, that is $10.04 million. 20 million the fund then distributes back to the shareholders, so that the NAV after distributions becomes 320.6. Next year again more could have been called down, more management fees, again the NAV. Now whatever is the NAV after 320.16, the management will get a further 20% carry on, or rather whatever is the value after 350.02, the management will get a carry on, not 320.16, which is after distributions. So the value has become 350.2. Whatever it goes up by from this level, it will be paid a carry on. So for 2009, calculate the management fees, carried interest, NAV before distributions, NAV after distributions. We've already calculated these. Compute the distributed to parent capital, residual value to parent capital, and the total value to parent capital for private equity fund A. Please do it for the year 2009. So management fees is 2% of 150, that is $3 million. Carried interest would be 20% of the value above $300 million. That comes out to be 50.2 into 20%, that is 10.04. Distributions is $20 million, so NAV before distribution would be 350.2, and the NAV after distribution would be 350 minus 10.04 minus 20, that is 320.16. Please note that for computing the carry in subsequent years, it is the increase over and above the NAV before distributions that will be checked, because we have already paid carry up till this level, or the watermark will now be set at this level. The distributed to parent capital would be calculated as $20 million that has been distributed divided by the parent capital of $150 million. Residual value to parent capital would be the residual value, that is 320.16 divided by the parent capital of $150 million. The total value to parent capital would be 320.16 plus 20, that is 340.16 divided by the parent capital of $150 million for private equity fund A in 2009. Similarly, you can do the calculation for 2006 that has been explained here. NAV before distribution is equal to the NAV after distribution in the prior year plus the capital called down minus the management fees plus the operating results. Silicon Corp is a semiconductor company, and its entrepreneurs believe that they can sell the firm for $100 million in 5 years. They need $10 million in capital now, and the entrepreneurs currently hold 1 million shares. The venture capital firm Genius Investors decides that given the high risk of the firm, a discount rate of 50% is appropriate. Calculate the pre-money, post-money valuation, ownership fraction, and price per share applying the NPV venture capital method using a single financing round. So the owners believe that they can sell the firm for $100 million in 5 years. However, this is after they receive $10 million that they need in capital now, and the entrepreneurs currently hold 1 million shares. So if this money comes in then with this $10 million of money, they would be able to create a value of $100 million at the end of 5 years. Hence, if we discount this value of $100 million that is expected to come at t equal to 5 at the rate of 50%, that is 100 upon 1.5 to the power 5, and this will give us the post money valuation today. That is, with this much value, they will be able to make it $100 million at the end of t equal to 5. So this will come out to be $13.17 million, or this is going to be the post money value today. Of this value, the venture capital firm is required to provide $10 million. And the remaining is for the or from the owners. So the ownership fraction of the venture capital firm should be 10 million divided by 13.17. That is approximately 75.9%. So if the entrepreneurs currently hold 1 million shares, then the company will have to issue new shares to the venture capital firm so that the venture capital firm's stake becomes 75.9%. Let's say F is the new number of shares that have been issued. Then F upon 1 plus F, because 1 million are already outstanding with the entrepreneurs, should be equal to 0.759. This will help us calculate the value of F, or the new shares that the firm needs to issue. Please verify that F comes out to be 3.149 million shares. Suppose that instead of a single round of financing of 10 million, the firm will need 6 million in the first round, that is today, and a second round 3 years later of 4 million to finance the expansion to the expected size at exit. Use discount of 50% for the first 3 years and 40% for the last 2 years. The firm is still expected to be worth $100 million after 5 years, and the founders will hold 1 million shares. So at equal to 5, the value of the firm is expected to be 100 million. However, it comes from 2 stages of financing. One at t equal to 3 and one initially at t equal to 0. So we will first calculate the post money value at t equal to 3. This 100 million will come only if both rounds of funding are complete. Only if the company gets these funds will the value be 100 million. So at t equal to 3, the post money value would be equal to 100 upon 1.4 to the power 2. Because if the firm has already reached t equal to 3, then the risk has reduced. The risk of cash flows and the risk of the firm surviving is much higher during the initial years. So from t3 to 5, the discount rate is 40%, and the post money value at t equal to 3 will come out to be $51.02 million. Of this $51.02 million, $4 million needs to be provided by the venture capital firm. So the pre-money valuation would be 51.02 minus 4 million, or the percentage ownership that will have to be diluted at this point for receiving this $4 million will not be very high, will be 4 upon 51.02. So this is the post money, this minus 4 will be equal to the pre-money valuation. So 4 upon 51.02 comes out to be approximately 7.84%. The pre-money value at t equal to 3 comes out to be $47.02 million, that is 51.02 minus 4. This is the value that will be reached if and only if the company gets a funding of $6 million at t equal to 0. So the post-money value is 51.02 or the pre-money value is 47.02 at the end of t equal to 3. If you discount this back 3 years at the rate of 50% where the risk is higher, this will give us the post-money value at t equal to 0. That is, after he has received the funding, this is the value that he'll be able to create, or this is the present value of that valuation. So the post-money valuation at t equal to 0 comes out to be $13.93 million. Of this 13.93, the venture capital fund has to supply $6 million. So the percentage shareholding of the venture capital fund will be 6 upon 13.93, that is equal to 43.07%. Let's now try to calculate the new shares that will have to be issued at each of these rounds. So in the first round, the venture capital fund, let's assume, gets F1 new shares. So F1 upon 1 plus F1 should be equal to 0.4307, because the stake of the venture capital firm is equal to 0.4307, which will give us F1 as approximately 0.75 million shares, or the total shares at the end of the first round will be 1.75 million. At the end of the second round, whoever is coming at this stage needs to be given a stake of 7.84%. So let's assume that F2 were the new shares issued at this point in time. So F2 upon 1.75, that has already been outstanding, plus F2 should be equal to 0.0784, because the new investor, if it's the same company, whatever has to be given a 7.84% stake for its investment. Solving this will give us F2, that is the new shares issued in the second round, as approximately 0.149 million shares. We can also compute the value of each share, because to begin with, the value of these 1.75, or rather these 0.75 million shares are corresponding to a value of $6 million, or the value of one share can be calculated as 6 upon 0.75. In the second round, the value of these 0.149 million shares is equal to 4 million. For 4 million you get 1.49 or 0.149 million shares. So the value of one share would be 4 upon 0.149. That is, at the beginning, at t equal to 0, the value of one share is approximately $8, whereas by the time the second round comes, the value of one share has become $26.8 per share. Please verify answers, guys. Okay, approximately this should be around the same. Assume a private equity investor has a discount rate of 40%. The investor believes that entrepreneurs' projections are overly optimistic and the chance of the company failing in a given year is 20%. Calculate the discount rate that factors in the company's probability of failure. That is, we will not account for this in the cash flows. Cash flows, will let it be 100. We won't do this. We will simply accommodate this in the discount rate. So if you're trying to do that, then R star should be equal to 1 plus R, that is 1 plus 0.4 divided by 1 minus 0.2 minus 1, which will come out to be 75%. Let's do one last question to wind up the review on private equity. In the previous valuation example, we were given a terminal value of $100 million. Assume scenario analysis is performed and examines 3 scenarios. The expected earnings are $10 million and the expected PE multiple is 10, resulting in $100 million. The firm is not successful, resulting in earnings of only 5 and the P is 8. So the expected terminal value is $40 million, and the firm fails so that its terminal value is 0. Assuming that all three scenarios are equally likely, compute the value of the firm, or compute the terminal value of the firm. So now the terminal value that will go into the calculation would be 1 by 3 into 100 plus 1 by 3 into 40 plus 1 by 3 into 0. This would then be discounted back at whatever the rate of interest is. In our previous example, it would be 50%. So the adjusted terminal value is all that we are interested in at the moment. We will discount it later. The adjusted terminal value will come out to be $46.67 million.